Rain says, so do you trade trend continuation like how we used to? Yeah, so I'll give you guys a comparison. So typical trend or traditional trend continuation trader. Let's say this is our trend. Typical traditional trend continuation trader. Look for pullback. Enter. These allergies are killing me. I apologize, guys. Enter at pullback and look to trade it up to the extension. So entry is there, exits here, and then maybe there's a secondary exit up here, or maybe you trail. Me, right? I enter here. My first targets always come off here. So my first targets always come off at a retest of structure because I don't trust that the market, this is my counter trend trading philosophy, I don't trust that the market is going to break through structure and continue to a new high, right? Because I'm so structure based. Structure is the most powerful thing that I believe in. So I assume that I know we shouldn't make assumptions, right? But I assume that every structure level is going to hold. Every structure level is a door which may be unlocked, but I'm going to assume it is locked. So I want to take profit off at the door. Now, what I'll do is my secondary target will come off at the extension. But as soon as we hit this first level of structure, I'm getting some money. I'm rolling stops to break even, so I can't lose any money. And then with the second half of my position, that's where I'm going to see if we can get that extension. So the pros and the cons of that is, well, the pros are obviously there's a little bit of safety in for moves that push up but don't extend, right? I make money and maybe a true trend continuation trader doesn't. Now, again, a true trend continuation may not lose money. You can always roll stops to break even. I know if I remember correctly, Cody does something like that where it's like, hey, once price gets to a danger level, stops get moved up to break even. So he may not make money on the trade, but at least he eliminates his chances of losing money, right? The cons of this are I can only take advantage of deep retracements in the market, right? Because if you think about it, if I need to take targets here, it's going to be very difficult for me to get quality risk rewards. I'm all over the place with my stuff. Gosh, I swear stuff keeps moving around on me. Here we go. If I take targets here, right, it's very difficult for me to get a good one-to-one risk reward because they're all over the place. Where if I'm taking targets at an extension, I can catch small pullbacks and look to trade them up. So I need to look for deeper pullbacks in order to take trades that give me a good risk reward. And then this is where it's kind of interesting because if we understand the kind of the fundamentals of how a market moves, if we're in a strong trend, should the pullback be deeper or shallower? In a strong trend, we should have shallow retracements. So it's weird because I am unable to take the moves that should tell me we're in the strongest trends, but I can take the moves that tell us we're in a weaker trend, right? So that's kind of the dilemma, and that's the give, right? I had to make a choice a very long time ago in my trading where it's like I couldn't do both, right? There were conflicts between my counter trend and my trend continuation, so I had to make a sacrifice. And again, I was counter trend first. Counter trend was my priority. The only reason I started, and I didn't do any type of trend trading for the longest time. The only reason I implemented it was to give me access to a different type of market condition, right? So something I found in the market was that there were certain periods of time where price was really, really directional. And although the majority of the time in the Forex market, price is more sideways in consolidation, the majority of the time I can make bank and make money hand over foot, right? But during those times where the markets were very directional, I had no way to profit, basically. And I would just have to sit back and take my beating, right? I'd have to Muhammad Ali get in the corner and just let George Foreman punch me until, he got tired and I can come back and exploit my counter trend trading. So I wanted to have exposure to those markets because I was sick of basically going through months and being like, okay, well, I'm just getting slaughtered this month. So I wanted to have an ability to have a way to take advantage of different market conditions. And no, it wasn't fully take advantage of it, but just a way to have some type of exposure and kind of, help out my equity curve, smooth out my equity curve, I guess you can say. So adding a way to take advantage of directional markets was key and very important. And although it's not the ideal way, I understand that it's a secondary approach. It's no different than having a secondary strategy, right? We talk about the DKC, the double Keltner channel strategy, right? It's Akil, how can you deal with that strategy where it goes on these massive losing streaks where the win percentage is so much lower than your comfort level, right? Well, because it's a secondary strategy. It's easier to trade that as a secondary strategy because it's not the main deal, right? It is, you have the main course and then you have this little side course where you can dip and take little bits from it, but it only complements the main thing and allows you to handle it a little bit better psychologically. So understanding that my counter trend trading is just secondary. It allows me to kind of get involved in just opportunities that I wouldn't be able to get involved in elsewise is massive. For me, the main thing was exposure to home run trades. Because in counter trend trading, right, where we're taking, let's say a double top, for example, it's counter trend, right? In counter trend, we are cookie jar, right? We are in, we are out. You're not looking for massive moves or big reversals in counter trend trades, right? Trend continuation traders or in trading opportunities, you can hit a runner. And it's opened up that ability for me to catch some of those big home run trades. And I always tell you guys, I only get a handful a year, right? I only take a handful a year. I may take or may shoot for maybe 5 or 6 a year. And I may hit on 1 or 2, right? 1 or 2 big ones. But you can ask any trader out there and any of the experienced traders we have on the platform. If you hit on 1 or 2 big trades a year that are maybe 2, 3, 4 times your normal reward, that makes a massive difference in your equity curve. A massive difference. So having that trend continuation exposure allows me to have exposure to those home run trades where I can take those shots and go for those big wins. But again, it's secondary, right? It's not the main approach. It's a secondary approach. So it's a pretty cool setup. And that's what we talk about, you guys, when we talk about developing your trading balance, your trading portfolio. It's not just a portfolio of pairs, but it's a portfolio of strategies, techniques, and tactics that allow you to take advantage of different elements of the market and find that true balance where you can have safety, yet exposure to kind of the big, home run moves that everyone talks about on the internet. And it's pretty cool when you can balance those out, when you can afford to shoot for those big ones, but still have the safety of kind of your, like we talked about advanced patterns the other day, kind of your old reliable in the background, keeping things steady. So you think about it from an equity curve perspective, right? You got your home run trade, which may, or your let's say your aggressive setup, which may give you a equity curve that looks like this, right? Maybe you like this because it gives you a massive amount of profit, but you don't like it because it has some pretty thick drawdowns. Maybe you have your boring old reliable, right? Your advanced patterns that looks like this, where it's like, or your counter trend trading, where it's like, just slow and steady churn, where it's like, you don't make as much profit, but you don't really deal with bigger drawdowns, right? Maybe you have something else that's, blah, 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 right? You put these things together, now you kind of get the best of both worlds, where you get these bigger returns, but these smaller drawdowns, and you don't get the massive profit, but you avoid the massive risk, and you end up somewhere in the middle. It's funny, I just did a podcast about this the other day, or last night, matter of fact. It's probably not going to come out until, I think I'm going to schedule it for Sunday, but it was a trader. I just did the podcast today about the surge trader stuff. And in it, I talked about another trader that got in trouble and sued by the SEC for basically guaranteeing like 10 to 20% results per day or something like that, or per month. And all I did was come in typical Akil fashion and say that, hey, I don't think 10 to 20% a month is realistic. I didn't say it was impossible, but I said I don't think it's a realistic expectation for most traders to think they're going to return 10 to 20% a month. And I got someone that commented and they were mad, or like, well, just because the tier 1 trading method doesn't produce 10 to 20% a month doesn't mean that, it can't be done. And I had to respond. And again, you'll hear this on Sunday or Monday. I said, hey, no, I never said it was impossible. I never said it was impossible. I just said it's not probable. And I talked about how what you return is not as much on your strategy as it is on you as a person, right? Would you guys agree? What your return on investment is not as much as your strategy, right? It's not as much like I have this magic strategy. It's more about you as a person and the risk you decide to take and the frequency that you decide to take, right? Me and Leo could be trading the same exact strategy and have completely different results. Leo could be risking more and making 20% a month. I could be risking less and making 5% a month. Same exact strategy. So it comes down to the trader and how you want to set yourself up, right? Because again, there may be a trader out there that loves these big, massive returns, right? Kevin may say, you know what? I'm willing to take a 10% drawdown every once in a while to hit this big, massive return because my risk appetite is there. Bud may be like, well, you know what? I'm not willing to ever lose 10% of my account. I'm okay losing like 3 to 4, and I'll take a small, steady return because maybe Bud's at that place in his life where he's like, hey, I don't really need to make a lot of money. I just don't want to risk it. And then maybe, Jake's somewhere in the middle where Jake's like, yeah, I'm okay risking a little bit more than 4%, but I don't want to touch 10%. And Jake finds it somewhere in the middle. And all these traders can be trading the exact same way and achieve this just by how they set up their trading from a frequency standpoint, from a portfolio standpoint, from a risk standpoint. But it's all about, we talk about the secret sauce, and that's what I told him in the podcast. I don't want to spoil the podcast. You guys need to listen to it, right? But I said in the podcast, I said, hey, there's no secret T1 method, right? We don't sell strategies and stuff like that here. We have strategies that we teach you, but it's not like, hey, here's our strategy, trade it. We teach you guys how to become well-rounded traders and how to develop a trading style or develop your own strategy or take a strategy that you learned from us or somewhere else on the internet and make it your own and fit it around your lifestyle goals. And this is what we're talking about when we say your lifestyle goals. What do you want to achieve? Do you want to achieve as much profit as possible? Because we can show you a way to do that. Do you want to achieve as little risk as possible? Because we can set your strategy up to do that. Do you want to be somewhere in the middle? However, whatever you want your goal to be, and there's no wrong answer to this, whatever you want your goal to be, you can set your strategy up around it. Again, we look at Cody for an example, or Kev right now, he's doing a challenge, or Rainer, or anyone that's got experience, right? Where maybe they've had to do certain challenges where they've had to hit certain quotas. And those quotas were outside what their normal trading was. So what they do, they just tweak their strategy a little bit, right? If my trading strategy usually produces 5%, but to pass this challenge, it says I have to produce 10%. Well, they just tweak their strategy. Maybe it's not in their comfort zone for their personal trading, but they know like, hey, for this specific thing, I have to achieve this. So I tweak this, I tweak that, and boom, I can take a more riskier approach. I may take a bigger drawdown, but I'll get the required return on investment, or maybe the opposite. Maybe you have a big return on investment, but your drawdowns are too big. I had to do this when I managed money, where I was telling these potential clients like, hey, I can produce this much for you. And they're like, yeah, but what's the drawdown? I'm like, well, it takes like a 12, 13% hit every once in a while. And they're like, well, no, I can't do that. If you can make this strategy, stay above the 8% mark, then we can talk. So I had to go back and be like, okay, well, I can keep the drawdown within 8%. It's going to minimize some of the profits. They're like, yeah, I'm cool with that. Right? So that's the skill of trading, being able to take whatever you have and adjust it per the situation, if you're managing money or doing a challenge or something like that, or adjust it per whatever your personal goals are. There's no secret. there's no secret. So